The global financial landscape, once an impenetrable fortress of brick-and-mortar institutions and established hierarchies, is undergoing an unprecedented seismic shift. For centuries, banks have been the undisputed custodians of our wealth, the gatekeepers of credit, and the architects of global commerce. They built their empires on trust, regulation, and a certain degree of inertia, creating a system that, while robust in many ways, was often slow, exclusive, and burdened by legacy. But what if everything you know about banking is rapidly becoming obsolete? What if the very foundations of this traditional edifice are being eroded by a force so powerful, so pervasive, that it promises to redefine not just how we manage our money, but the very structure of the global economy? This force is Fintech, and its ascent is not merely an evolution. It is a revolution, questioning the very necessity of traditional banks as we've always understood them. We stand at a pivotal moment, witnessing the dawn of a new financial era. The question is no longer if change is coming, but how profound that change will be, and whether the venerable institutions that have dominated finance for generations can adapt, or if they are destined to become relics of a bygone age. This isn't just about faster payments or sleek apps. It's about a fundamental re-architecture of financial services driven by exponential technological progress and the relentless focus on the user experience. From the bustling markets of London and New York to the rapidly developing economies of Africa and Asia, Fintech is democratizing access, lowering costs, and accelerating transactions at a pace that was unimaginable just a decade ago. It's a story of innovation, disruption, and the relentless march of progress, compelling us to ask, is this truly the end of traditional banks, or merely the beginning of their most significant transformation yet? Before we delve into the disruptive power of Fintech, it's crucial to understand the bedrock upon which the traditional banking system was built, and critically, to identify its inherent vulnerabilities. For hundreds of years, commercial banks have served as the central nervous system of economic activity. Their core functions are deceptively simple yet profoundly impactful: accepting deposits, safeguarding savings, issuing loans, facilitating payments, and providing a range of financial advisory services from wealth management to corporate finance. This model, refined over centuries, created immense stability and fostered economic growth by channeling capital efficiently. The traditional bank operates on a hub-and-spoke model, with physical branches acting as key points of interaction. Trust was built on personal relationships, the perceived security of a physical vault, and the reassuring presence of a human teller. Their business model relies heavily on interest rate differentials, borrowing at a lower rate from depositors and lending at a higher rate to borrowers, augmented by fees for various services. This structure, coupled with extensive regulatory oversight, created a relatively stable, albeit often slow-moving, system. The regulatory framework, developed over decades, aimed to protect consumers, prevent financial crises, and ensure systemic stability, making banks indispensable pillars of national economies. However, this deeply entrenched system, while robust, harbored significant weaknesses that were ripe for exploitation by technological innovation. One of the most glaring vulnerabilities is the sheer inefficiency embedded within legacy systems. Many traditional banks operate on decades-old IT infrastructure, often a patchwork of disparate systems that are costly to maintain, difficult to integrate, and slow to update. This technological debt translates directly into operational inefficiencies, which manifest as slow transaction processing, cumbersome account opening procedures, and a general lack of agility in responding to market changes or customer demands. The reliance on batch processing for many transactions, rather than real-time updates, further exemplifies this technological lag. Furthermore, the extensive physical footprint of traditional banks, thousands of branches, Vast employee networks and significant overheads contributes to high operating costs. These costs are inevitably passed on to consumers in the form of higher fees for services, less competitive interest rates, and minimum balance requirements that can exclude lower-income individuals. This economic barrier limits accessibility, particularly for populations in rural areas or developing countries where banking infrastructure is sparse. Another critical vulnerability lies in the customer experience. For many, interacting with a traditional bank is synonymous with bureaucracy, long wait times, and the lack of personalized service. The digital transformation within traditional banks has often been reactive rather than proactive, attempting to shoehorn digital channels onto existing, often inflexible, processes. This has resulted in online banking experiences that are often clunky, unintuitive, and fail to meet the expectations of a generation accustomed to seamless, on-demand digital interactions across other sectors. The 2008 global financial crisis served as a profound catalyst, exposing deep fissures in public trust and highlighting the systemic risks inherent in an overly concentrated and opaque financial system. While reforms were enacted, the crisis left a lasting impression, fostering a widespread desire for more transparent, accessible, and user-centric financial services. This period of widespread distrust and dissatisfaction created a fertile ground for disruption, paving the way for innovative startups unencumbered by legacy systems or the need to restore a tarnished reputation. The global recession that followed further underscored the need for more efficient capital allocation and access to credit for small businesses and individuals, areas where traditional banks, constrained by tighter regulations and risk aversion, often fell short. In essence, traditional banks, for all their historical importance and systemic stability, were inadvertently building the perfect storm for fintech. Their inherent slowness, high costs, limited accessibility, and often subpar customer experience, combined with the post-2008 erosion of trust and the rapid advancements in digital technology, created a vacuum that fintech was perfectly positioned to fill. The stage was set for a new breed of financial service providers to emerge, armed with technology and a customer-first ethos, ready to challenge the status quo and fundamentally redefine the financial landscape. So, what exactly is fintech? The term itself, a portmanteau of financial technology, broadly refers to any innovation that improves or automates the delivery and use of financial services. It's an umbrella term encompassing a vast and rapidly expanding ecosystem of companies, products, and services that are leveraging technology to make financial transactions more efficient, accessible, and user-friendly. But to truly grasp its revolutionary potential, we need to move beyond a simple definition and understand its core pillars and diverse applications. At its heart, fintech is driven by several foundational technological advancements that have reached a critical mass in recent years. Firstly, artificial intelligence, AI, and machine learning, ML, are powering sophisticated algorithms for everything from fraud detection and credit, scoring to personalized financial advice and automated trading. These technologies can process vast amounts of data at speeds and scales impossible for humans, identifying patterns, making predictions, and optimizing outcomes with unprecedented accuracy. For instance, AI-driven credit models can assess a borrower's creditworthiness using non-traditional data points, extending credit to individuals historically overlooked by conventional systems. Secondly, blockchain technology. The distributed ledger system underpinning cryptocurrencies like Bitcoin is revolutionizing security, transparency, and efficiency in financial transactions. Beyond digital currencies, blockchain offers immutable records, smart contracts that automate agreement execution, and the potential for decentralized finance, DeFi, which aims to remove intermediaries from financial transactions altogether. This technology promises to drastically reduce settlement times, lower transaction costs, and enhance the security of financial data. Thirdly, cloud computing has provided fintech startups with scalable, cost-effective infrastructure. Instead of investing heavily in their own servers and data centers, fintech companies can leverage cloud services to build and deploy applications rapidly, scale operations up or down as needed, and access advanced computing capabilities without prohibitive upfront costs. This democratizes access to sophisticated technology, allowing nimble startups to compete with established giants. Fourthly, mobile technology is perhaps the most visible enabler of fintech. Smartphones have become ubiquitous, transforming how people access services, communicate, and manage their lives. Fintech capitalizes on this by delivering financial services directly to the palm of the user's hand, making banking, payments, and investments accessible anytime, anywhere. Mobile apps are the primary interface for many fintech offerings, designed for intuitive navigation and instant gratification. Finally, big data analytics is the engine that fuels much of fintech's innovation. Every digital interaction generates data, and fintech companies are adept at collecting, analyzing, and deriving actionable insights from these massive data sets. This allows for hyper-personalized products, more accurate risk assessments, and a deeper understanding of customer behavior, leading to more tailored and effective financial solutions. The applications of fintech span virtually every segment of financial services, disrupting and redefining each in its wake. In the payments sector, fintech has led to the proliferation of mobile wallets, peer-to-peer, P2P payment apps, and instant cross-border transfer services. Companies like PayPal, Venmo, Square Cash, and Wise, formerly TransferWise, have made sending money as easy as sending a text message, often with significantly lower fees and faster processing times than traditional bank wire transfers. QR code payments are now commonplace in many parts of the world, simplifying transactions for both consumers and merchants. Lending has been transformed by alternative models. Peer-to-peer lending platforms connect borrowers directly with investors, bypassing traditional banks and offering more competitive rates. Algorithmic lending platforms use AI to assess creditworthiness in minutes, providing rapid access to capital for individuals and small businesses that might struggle with conventional loan applications. Micro-lending platforms, often powered by mobile technology, are providing vital access to credit in developing economies, fostering entrepreneurship and financial inclusion. In wealth management, robo-advisors have democratized investment. Platforms like Betterment and Wealthfront use algorithms to build and manage diversified investment portfolios, based on a user's risk tolerance and financial goals, all at a fraction of the cost of traditional human advisors. These services often have lower minimum investment requirements, making professional financial advice accessible to a broader demographic. InsurTech applies similar technological principles to the insurance industry, offering personalized policies, automated claims processing, and usage-based insurance models powered by data from connected devices. This leads to more efficient underwriting, fairer pricing, and a more streamlined customer experience. RegTech, regulatory technology, is an emerging segment that uses technology to help financial institutions comply with complex regulatory requirements more efficiently and cost-effectively. AI and machine learning are employed to monitor transactions for fraud, money laundering, and other illicit activities, improving compliance and reducing the burden on human analysts. And of course, the broader category of blockchain and cryptocurrencies continues to evolve, pushing the boundaries of what's possible in finance. Beyond speculative trading, the underlying technology promises to create a more decentralized, transparent, and immutable financial infrastructure, paving the way for innovations like stablecoins, central bank digital currencies, CBDCs, and entirely new forms of asset tokenization. What unites these diverse fintech applications is a shared philosophy, a relentless focus on the user, a commitment to efficiency, and a drive to leverage technology to solve pain points inherent in traditional finance. Fintech companies are not just building better products. They are fundamentally rethinking how financial services are delivered, making them more accessible, affordable, and aligned with the demands of the digital age. This is the revolution in motion, and its impact is already being felt across the global economy. The conceptual understanding of fintech is one thing. Witnessing its disruptive power in action across various segments of financial services is another entirely. This is where the rubber meets the road, where innovative technologies are translated into tangible products and services that are actively siphoning market share from traditional banks and fundamentally altering consumer expectations. Let's begin with payments, arguably the most visible and widely adopted area of fintech disruption. The traditional payment infrastructure, reliant on card networks, clearinghouses, and interbank transfers, is inherently slow and often expensive, particularly for cross-border transactions. Fintech has swooped in with solutions that are faster, cheaper, and more convenient. Mobile wallets such as Apple Pay, Google Pay, and Samsung Pay allow users to make payments directly from their smartphones, eliminating the need for physical cards. These platforms leverage near-field communication, NFC, technology for contactless payments, offering enhanced security through tokenization and biometric authentication. The sheer convenience of leaving your wallet at home, knowing your phone can handle all transactions, has driven rapid adoption. Beyond point-of-sale, peer-to-peer P2P, payment apps like Venmo, PayPal, and Square Cash have revolutionized how individuals send money to each other. Splitting bills with friends, paying rent, or sending money to family members can now be done in seconds, often for free and with a few taps on a smartphone. These services bypass the traditional banking rails for many domestic transactions, settling funds within their own ecosystems or leveraging faster payment networks. For international transfers, companies like Wise, formerly TransferWise, have drastically cut down on fees and waiting times, offering real exchange rates and transparent pricing, directly challenging the lucrative foreign exchange businesses of traditional banks. Their model aggregates payments to reduce the number of actual cross-border transfers, thereby minimizing costs and accelerating delivery. The rise of instant payment systems, like the UK's Faster Payment Service or India's UPI, further underscores this shift, enabling real-time money transfers that make traditional ACH or wire transfers seem archaic. Next, consider lending, a cornerstone of traditional banking that has seen significant fintech innovation. Traditional loan applications are notoriously lengthy, document-intensive, and often biased towards borrowers with established credit histories. Fintech has introduced peer-to-peer P2P lending platforms like Lending Club and Prosper, which directly connect individual borrowers with individual or institutional investors. By cutting out the bank as an intermediary, these platforms can often offer more competitive interest rates to borrowers and higher returns to investors. The entire process from application to funding is typically digital and significantly faster. Beyond P2P, algorithmic credit scoring is transforming how credit decisions are made. Fintech lenders utilize AI and machine learning to analyze a vast array of data points beyond traditional credit scores, including utility payments, rental history, social media activity, and even psychometric data to assess creditworthiness. This allows for more nuanced risk assessments and, crucially, extends credit to thin-file or no-file individuals and small businesses that might be rejected by traditional banks due to a lack of conventional credit history. Companies like Cabbage, now part of American Express, and OnDeck have provided rapid, accessible loans to small businesses, filling a critical gap left by risk-averse legacy lenders. In developing economies, mobile-first lending apps are providing microloans to entrepreneurs and individuals, fostering economic development and financial inclusion in ways traditional banks simply couldn't. Wealth management has also been profoundly disrupted, moving from an exclusive service for the affluent to an accessible tool for the masses. Robo-advisors such as Betterment, Wealthfront, and Vanguard Personal Advisor Services utilize algorithms to construct and manage diversified investment portfolios tailored to an individual's financial goals, risk tolerance, and time horizon. These platforms offer sophisticated portfolio rebalancing, tax loss harvesting, and goal-based planning, all at a fraction of the cost of traditional human financial advisors. Their low minimum investment requirements have democratized access to professional investment advice, allowing younger investors and those with smaller asset bases to participate in the market more effectively. The user experience is typically intuitive, app-based, and provides real-time insights into portfolio performance, making investment less intimidating and more engaging. Perhaps one of the most direct challenges to traditional banks comes from challenger banks or neobanks. These are fully digital banks operating without physical branches, built from the ground up on modern technology stacks. Companies like Revolut, N26 Monzo, and Chime offer a range of banking services, checking accounts, savings accounts, debit cards, and sometimes even loans entirely through mobile apps. Their appeal lies in their superior user experience, often instant account opening, real-time transaction notifications, budgeting tools, lower fees or no fees, and innovative features like splitting bills or setting spending limits. By eliminating the overhead of physical branches and legacy systems, they can offer more competitive pricing and a more responsive, customer-centric service model. While many of these neobanks operate under existing banking licenses or partner with traditional banks, their front-end user experience and operational efficiency represent a direct threat to the traditional retail banking model. Finally, the most profound and potentially transformative disruption comes from blockchain and cryptocurrencies, particularly in the realm of decentralized finance, DeFi. While often associated with speculative trading, the underlying blockchain technology offers a paradigm shift in financial infrastructure. DeFi aims to recreate traditional financial instruments, lending, borrowing, trading, insurance, on public blockchains, removing the need for intermediaries like banks or brokers. Through smart contracts, self-executing agreements whose terms are directly written into code, financial transactions can be automated, transparent, and executed without human intervention. This promises to reduce costs, increase speed, and enhance security by eliminating single points of failure. Cryptocurrencies like Bitcoin and Ethereum are foundational to this movement, providing a decentralized, peer-to-peer medium of exchange and a platform for building complex financial applications. Beyond these, stablecoins, cryptocurrencies pegged to fiat currencies, offer a bridge between the traditional and crypto worlds, providing stability for transactions within DeFi ecosystems. The tokenization of real-world assets, from real estate to art, on blockchain platforms could unlock new forms of liquidity and fractional ownership. Furthermore, the concept of central bank digital currencies, CBDCs, digital versions of a country's fiat currency issued by its central bank, is gaining traction globally. While not decentralized like typical cryptocurrencies, CBDCs represent a significant technological modernization of monetary systems, promising more efficient payments and potentially new avenues for monetary policy, and they will inevitably interact with and influence the broader fintech landscape. In summary, Fintech's disruption is multifaceted and pervasive. From making daily payments frictionless to democratizing complex financial services like investment and lending, it is fundamentally reshaping how individuals and businesses interact with money. The common thread is a move towards greater efficiency, transparency, accessibility, and user centricity, forcing traditional institutions to either adapt rapidly or risk being relegated to the sidelines of a rapidly evolving financial future. The question is no longer asterisk if asterisk fintech is changing things, but asterisk how deeply asterisk it will integrate into the very fabric of our economic lives. The impact of fintech extends far beyond mere technological upgrades. It is fundamentally reshaping the global economic landscape, creating new opportunities, challenging existing power structures, and driving profound shifts in how capital flows, how wealth is generated, and how economies function. This isn't just about individual apps. It's about systemic changes with far-reaching consequences. One of the most significant impacts of fintech is its role in fostering financial inclusion. Globally, billions of people remain unbanked or underbanked, lacking access to basic financial services like savings accounts, credit, or insurance. This exclusion perpetuates poverty, hinders entrepreneurship, and limits economic growth. Fintech, particularly through mobile money platforms, has made monumental strides in addressing this gap. In sub-Saharan Africa, for instance, platforms like M-Pesa have transformed economies by enabling millions to send and receive money, pay bills, and even access microloans using only their mobile phones. These services bypass the need for physical bank branches, traditional identification documents, and complex bureaucratic processes, bringing previously marginalized populations into the formal financial system. This inclusion not only empowers individuals, but also stimulates local economies by facilitating commerce and investment at the grassroots level. Fintech also drives immense efficiency and cost reduction across the financial system. By automating processes, digitizing records, and eliminating intermediaries, fintech companies can operate with significantly lower overheads than traditional banks. This efficiency translates into lower transaction fees for consumers, more competitive interest rates on loans and savings, and faster processing times for virtually all financial services. For businesses, fintech solutions can streamline payroll, optimize treasury management, and facilitate cross-border trade more cost-effectively. The cumulative effect of these efficiencies on a global scale is a reduction in the friction of economic activity, allowing capital to flow more freely and productively. This can lead to higher investment, increased trade, and ultimately, accelerated economic growth. The rise of fintech has ignited intense competition and innovation within the financial sector. Traditional banks, initially slow to respond, are now compelled to innovate or face obsolescence. This competition benefits consumers by forcing all players to offer better services, lower fees, and more user-friendly experiences. Many large banks have responded by investing heavily in their own digital transformations, acquiring fintech startups, or forming strategic partnerships. This dynamic has led to a fascinating convergence, where traditional banks are becoming more tech-savvy, and fintech companies are increasingly navigating regulatory landscapes, sometimes even applying for banking licenses themselves. This symbiotic relationship, where both compete and collaborate, is accelerating the pace of innovation across the entire industry. Furthermore, fintech is profoundly impacting the globalization of finance. Cross-border transactions, historically complex, expensive, and slow, are becoming increasingly seamless. Fintech platforms facilitate faster, cheaper international payments and remittances, benefiting migrant workers sending money home, international businesses, and global e-commerce. This enhanced connectivity breaks down geographical barriers to trade and investment, allowing capital to seek out the most productive opportunities regardless of location. It also fosters greater economic integration, making it easier for businesses in emerging markets to access global capital and for consumers worldwide to access a broader range of products and services. The economic impact also extends to new business models and job markets. Fintech has spawned an entirely new industry, creating thousands of jobs in software development, data science, cybersecurity, compliance, and product management. It has fostered a vibrant startup ecosystem, attracting significant venture capital investment and driving economic growth in tech hubs around the world. However, this disruption also poses challenges to traditional employment in the banking sector. As processes become automated and digital, jobs related to branch operations, manual data entry, and certain administrative functions may decline. The evolving landscape necessitates a focus on reskilling and upskilling the workforce to adapt to the demands of a more technologically advanced financial industry. Finally, the pervasive use of data and personalization by fintech companies is reshaping consumer expectations and product development. Fintech leverages big data analytics and AI to understand individual financial behavior at an unprecedented level. This allows for the creation of hyper-personalized financial products and services, from tailored investment advice to dynamic credit offerings and proactive budgeting tools. While this offers significant benefits to consumers in terms of relevance and convenience, it also raises important questions about data privacy, security, and the potential for algorithmic bias. The ethical considerations surrounding the use of vast quantities of personal financial data are becoming increasingly critical for regulators and consumers alike, shaping the future of data governance in the financial sector. In essence, fintech is not merely a technological trend. It is a fundamental economic force. It is democratizing access to finance, driving efficiency, fostering innovation, breaking down geographical barriers, and creating new economic opportunities while simultaneously posing significant challenges to existing structures and workforces. Its ongoing evolution will continue to be a primary determinant of global economic dynamics for decades to come, demanding adaptability and foresight from all stakeholders, governments, businesses, and individuals alike. Despite its transformative potential and undeniable benefits, the fintech revolution is not without its challenges and inherent risks. Navigating these complexities is crucial for ensuring that the future of finance is both innovative and stable, inclusive and secure. The road ahead requires careful consideration and proactive measures from regulators, innovators, and consumers alike. One of the most significant hurdles for fintech is regulatory oversight. Innovation in fintech often outpaces the ability of traditional regulatory frameworks to adapt. Existing financial regulations were designed for a different era, centered around large, established banks operating within clearly defined geographical boundaries. Fintech, with its borderless nature, rapid development cycles, and diverse range of new players, often falls into gray areas or necessitates entirely new regulatory approaches. Regulators face the delicate balancing act of fostering innovation without compromising consumer protection, financial stability, or the integrity of the global financial system. Too much regulation can stifle innovation, while too little can lead to systemic risks, fraud, and market instability. This is particularly evident in the cryptocurrency and DeFi space, where the decentralized nature often clashes with traditional jurisdictional controls and anti-money laundering (AML) regulations. The lack of a harmonized global regulatory framework further complicates matters, creating opportunities for regulatory arbitrage and increasing compliance costs for internationally operating fintech firms. Cybersecurity risks are another paramount concern. As financial services become increasingly digital and interconnected, they become more attractive targets for cybercriminals. Fintech companies, often newer and sometimes less resourced than large traditional banks, can be particularly vulnerable to data breaches, phishing attacks, ransomware, and other forms of cybercrime. The potential for a large-scale cyber attack on a widely used fintech platform or a critical piece of blockchain infrastructure could have devastating consequences, eroding public trust and causing significant financial losses. Protecting sensitive financial data and ensuring the resilience of digital payment and investment systems is a continuous and escalating challenge that requires constant vigilance, robust security protocols, and significant investment. Closely related to cybersecurity are data privacy concerns. Fintech thrives on collecting and analyzing vast amounts of personal and financial data to personalize services and assess risk. While this can offer significant benefits, it also raises serious questions about who owns this data, how it is used, and how it is protected. Regulations like GDPR in Europe and CCPA in California are attempts to give consumers more control over their data. But the global nature of fintech means that data often crosses borders, complicating enforcement. The potential for misuse of data, algorithmic bias in credit decisions, or the aggregation of personal financial information for purposes beyond its initial collection poses ethical dilemmas and demands transparent data governance practices. There is also the risk of market concentration. While fintech initially fostered a landscape of agile startups, there's a growing concern that as the industry matures, a few dominant players, perhaps large tech companies, big tech like Apple, Google, Amazon, or Facebook, Meta, or a handful of massively successful fintech unicorns could come to control significant portions of the financial services market. This concentration could lead to less competition, reduce choice for consumers, and potentially allow these dominant firms to exert undue influence over economic activity, similar to concerns raised about traditional banking monopolies in the past. The blurring lines between technology and finance, with big tech increasingly entering the financial services arena, further exacerbates this concern as these companies bring immense capital, vast user bases, and sophisticated data analytics capabilities to the table. Finally, the digital divide presents a challenge to the promise of universal financial inclusion. While fintech can bring services to the unbanked, it relies on access to smartphones, internet connectivity, and digital literacy. Populations in remote areas, older demographics, or those with limited access to technology may be left behind, exacerbating existing inequalities rather than alleviating them. Ensuring equitable access and providing necessary digital education are crucial to prevent the creation of a new form of financial exclusion in the digital age. So, what about the future role of traditional banks? They are certainly not destined for immediate extinction. Instead, they are being forced to adapt, evolve, and often collaborate. Many traditional banks are investing heavily in their own digital capabilities, acquiring fintech startups, or partnering with them to leverage their technology and agility. They are increasingly becoming fintech enablers, providing the regulated infrastructure and trust that many smaller fintechs still rely on. Hybrid models are emerging, where banks offer digital-first experiences while retaining the option of physical branches for complex services or specific customer segments. Their deep understanding of regulation, vast customer bases, and significant capital reserves remain powerful assets, allowing them to participate in rather than simply be overrun by the fintech revolution. The challenge for them is to shed legacy mindsets and systems fast enough to remain relevant. The convergence of big tech and fintech is also a critical trend to watch. Companies like Apple and Google are not just facilitating payments. They are moving into lending, savings, and broader financial ecosystems. Their massive user bases, data insights, and brand loyalty pose a formidable competitive threat to both traditional banks and smaller fintechs. This blurring of lines between technology companies and financial institutions will continue to redefine the competitive landscape, creating an environment where traditional distinctions become increasingly meaningless. In conclusion, the journey ahead for fintech is one of immense promise coupled with significant challenges. Addressing regulatory complexities, fortifying cybersecurity, safeguarding data privacy, mitigating market concentration, and bridging the digital divide will be paramount. The future will likely be characterized by a hybrid financial system where traditional institutions, nimble fintechs, and powerful big tech companies compete, collaborate, and converge, all driven by the relentless pursuit of more efficient, accessible, and user-centric financial services. The question is no longer asterisk if asterisk change is happening, but how we collectively shape its trajectory to ensure a resilient, inclusive, and prosperous global financial future. So, are we witnessing the definitive end of traditional banks? The comprehensive analysis suggests not an outright demise, but a profound and irreversible metamorphosis. The provocative question posed in our title, the end of traditional banks? Fintech is changing everything you know, is best answered with nuance. Traditional banks, in their archaic, branch-heavy, and often bureaucratic forms, are indeed facing an existential threat. The inertia and legacy systems that once provided stability are now their greatest liabilities. In an era demanding agility and digital fluency, Fintech has unequivocally changed everything we know about financial services. It has democratized access to finance, extending credit, payment solutions, and investment opportunities to billions previously excluded. It has driven unprecedented efficiencies, reducing costs and accelerating transactions across the globe. It has fostered an environment of relentless innovation, pushing the boundaries of what is possible with money and financial interactions. The user experience, once an afterthought, is now at the forefront, setting new standards that traditional institutions struggle to meet. The future of finance will not be a monolithic entity dominated by a single type of institution. Instead, it will be a complex, integrated ecosystem. Traditional banks will likely survive, but only if they adapt fundamentally. This adaptation involves shedding legacy technology, embracing digital-first strategies, fostering a culture of innovation, and perhaps most crucially, partnering with or acquiring the very fintech companies that initially sought to disrupt them. We are already seeing this evolution, banks becoming fintech enablers, leveraging their regulatory expertise, capital, and trust to support agile startups. They will likely focus on complex financial products, large-scale corporate finance, and the underlying infrastructure that fintechs often build upon. Meanwhile, fintechs will continue to push the boundaries, specializing in niche markets, developing cutting-edge technologies like DeFi, and relentlessly focusing on specific customer pain points. The entrance of big tech into the financial arena further complicates this landscape, bringing immense resources and user bases that blur the lines between technology and finance. Ultimately, the traditional bank, as a singular, all-encompassing entity, is giving way to a more fragmented, specialized, and interconnected financial services industry. The customer will be at the center, benefiting from greater choice, lower costs, and superior experiences. The era of slow, expensive, and exclusive finance is drawing to a close, replaced by a dynamic, inclusive, and technologically advanced paradigm. The end of banks as we knew them is not a destructive conclusion, but a transformative beginning for a more efficient and accessible global economy. If you found this deep dive into fintech and its impact on traditional banking insightful, and if you're keen to stay ahead in understanding the intersection of technology and the global economy, consider subscribing to our channel. Your support helps us continue to produce detailed analyses like this. Thank you for watching.